Welcome to our comprehensive NZD/USD analysis for November 3rd through 8th, 2025. This week marked a critical turning point for the New Zealand dollar, which emerged as the weakest performer among G10 currencies. In this presentation, we'll examine the perfect storm of bearish factors that drove NZD/USD to multi-month lows, analyze key technical levels that traders must watch, and provide actionable trading strategies for both short-term and medium-term timeframes. We'll cover the shocking labor market data that cemented the Reserve Bank of New Zealand's dovish path, the global risk-off sentiment triggered by AI bubble fears, and the critical events ahead that could determine the pair's direction. Prepared on November 10th, 2025, this analysis synthesizes data from TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex to give you a complete market picture. New Zealand dollar to US dollar closed at 0.56310 as of November 9th, showing a marginal daily gain of just 0.08%, but this masks severe underlying weakness. Looking at the performance metrics, the picture becomes clear. Down 0.41% over 5 days, down 2.06% over 1 month, and down a significant 5.16% over 6 months. The 1-year performance shows a loss of 6.56%, while the 5-year decline stands at a staggering 17.43%. Technical indicators show neutral readings on both oscillators and moving averages, but this neutrality is deceptive. The short-term stabilization cannot hide the medium-term deterioration evident across all major timeframes. The pair traded in a narrow range between 0.56204 and 0.56337 during the session, with volume at 12.08k ticks. This is a currency under sustained pressure, and the performance data tells the story of persistent weakness that traders cannot ignore. 8 major catalysts shaped NZD/USD during this period, with bearish factors overwhelming the limited bullish support. On the bullish side, we had just 2 factors: the US-China preliminary trade deal from October 26th to 27th that temporarily boosted risk sentiment, and improved New Zealand business confidence shown in the ANZ survey on October 30th. But these were completely overwhelmed by 6 powerful bearish forces. First, New Zealand's unemployment surged to 5.3%, the highest since 2016, with flat job growth. Second, the RBNZ maintains a dovish bias with a 91% probability of a rate cut on November 26th. Third, the Fed's hawkish 25 basis point cut disappointed NZD bulls and triggered a sell-off. Fourth, global risk-off sentiment emerged as AI bubble fears triggered a major stock market sell-off, with NASDAQ down 330 points. Fifth, the U.S. government shutdown created data uncertainty, forcing traders to rely on sentiment rather than facts. Sixth, the Supreme Court tariff case, with a 60% probability of ruling against Trump, weighs on global growth expectations. The net impact is clear. Bearish momentum dominates. The Q3 employment data released on November 5th removed all doubt about the RBNZ's next move. Unemployment hit 5.3%, the highest level since 2016. Job growth was completely flat at 0%, representing a total stall in employment momentum. Youth disengagement is accelerating, pointing to structural issues beyond just cyclical factors. The market reaction was immediate and severe. New Zealand dollar tumbled to become the weakest G10 currency. This data cements a 91% probability that the RBNZ will cut rates by 25 basis points to 2.25% at their November 26th meeting. Looking ahead to 2026, there's a 50-50 probability of further rate cuts, essentially a coin toss. The critical issue here is policy divergence. While the RBNZ continues its dovish easing cycle, the Federal Reserve has adopted a hawkish pause after its 25 basis point cut. This divergence creates a structural headwind for NZD/USD that will persist for months. The technical picture confirms the bearish fundamental narrative. 3 critical breaks signaled downside acceleration. First, the falling channel support was violated, confirming the pattern breakdown and bearish momentum. Second, the 100% Fibonacci projection at 0.5687 was broken, indicating that downside acceleration is now underway. Third, multiple support failures show strong selling pressure and weak buying interest. Looking at resistance levels, 0.5800 is the critical level that determines bias. As long as this resistance holds, the outlook remains bearish. Below that, we have 0.5750 as key resistance, 0.5687 as the broken 100% projection level, and 0.5650 as immediate resistance. On the support side, 0.5620 provides immediate support, with 0.5600 as the psychological level. The next major targets are 0.5490, which represents the 161.8% Fibonacci projection, and 0.5484 as the major support zone. The technical outlook is clear, bearish as long as 0.5800 resistance holds, with a target zone of 0.5490 to 0.5600. For the next 1 to 2 weeks, we recommend a probability-weighted approach. The short strategy is our recommended play with 65% probability. Enter at 0.5650 on any rally toward resistance. Target the 0.5550 to 0.5600 zone and place your stop loss at 0.5680. This gives you a favorable 1 to 2 risk-reward ratio. The entry condition is key. Wait for a rally to resistance rather than chasing the market lower. For those looking at counter-trend opportunities, the long strategy carries 35% probability. Enter at 0.5600 at the psychological support level. Target 0.5650 to 0.5700 with a stop loss at 0.5580. This offers a 1 to 2.5 risk-reward ratio. The key events to monitor are the RBNZ Monetary Policy Meeting on November 26th, with its 91% cut probability, and U.S. economic data releases if the government shutdown ends. The hostile fundamental environment favors shorts on rallies, but disciplined traders can also look for tactical long opportunities at key support levels. Looking out 1 to 3 months, we assign a 60% probability to the bearish scenario versus 40% for the bullish scenario. The bearish scenario assumes the RBNZ delivers a 25 basis point cut on November 26th and signals potential for further easing. The New Zealand labor market continues to weaken. Global risk sentiment remains fragile amid AI bubble concerns, and the Fed maintains its cautious stance on further rate cuts. Under this scenario, we target 0.5400 to 0.5500, with a strategy to sell rallies toward 0.5650 to 0.5700 resistance, using stops above 0.5750. The bullish scenario, with 40% probability, requires significant shifts. The RBNZ signals that November's cut may be the last, adopting a neutral stance. New Zealand economic data shows unexpected resilience. Global risk sentiment improves dramatically, and the Fed signals more aggressive easing, weakening the USD broadly. This scenario targets 0.5850 to 0.5950, with a strategy to buy dips towards 0.5600 to 0.5620 support. Our base case recommendation is that the incremental downturn continues, favoring bearish positioning while monitoring key events for potential scenario shifts. Global risk-off sentiment hit markets hard on November 4th, with the Nasdaq down 330 points, the S&P 500 down 63 points, and the Dow down 265 points. This was the strongest sell-off in months, driven by AI bubble fears. Goldman Sachs CEO warned of a likely 10 to 20% drawdown over the next 2 years, adding to investor caution and triggering a flight to safety. The currency performance rankings tell the story clearly. The Japanese yen emerged as the strongest major currency, benefiting from safe haven demand. EUR and GBP were strong. USD was mixed but regained ground on Friday. CHF was mixed. CAD was weak. AUD was weak due to risk-off pressure. And NZD was the absolute weakest, suffering from both risk-off sentiment and domestic weakness. The key insight here is that NZD moves with risk sentiment, not fundamentals. As a high beta currency, it's particularly vulnerable to global risk-off flows. This correlation dominates price action and will continue to be the primary driver in the near term. Let's examine the risk factors. Downside risks carry higher probability. Further labor market deterioration, with unemployment rising above 5.5%, would force the RBNZ to consider more aggressive easing. Global recession fears could materialize if AI bubble concerns translate into a broader market crash, intensifying risk-off flows. China's economic slowdown could deepen, which matters because New Zealand's economy is heavily dependent on Chinese demand for exports. The RBNZ could signal an extended easing cycle, with markets pricing in deeper rate cuts beyond November. On the upside, lower probability risks include positive New Zealand economic surprises in labor market or business confidence data, a Fed dovish pivot signaling more aggressive easing, a sustained risk-on rally in global equity markets, or China stimulus measures that would benefit NZD via trade linkages. 3 key events to monitor. November 26th, RBNZ meeting with 91% cut probability. December 10th, Federal Reserve meeting with 70% cut probability, and the ongoing U.S. shutdown resolution and Supreme Court tariff case with 60% probability of ruling against Trump. Let's summarize the 5 key takeaways. First, NZD is the worst G10 performer with unemployment at an 8-year high of 5.3%. Second, the RBNZ's dovish path is cemented by weak labor data, with 91% probability of a November 26th cut. Third, the technical breakdown below 0.5687 confirms bearish momentum acceleration. Fourth, global risk-off sentiment is particularly damaging for high beta NZD. Fifth, policy divergence between the RBNZ's easing and the FED's hawkish pause creates a structural headwind. For trading recommendations in the short term of 1 to 2 weeks, favor shorts at 0.5650 resistance targeting 0.5550 to 0.5600 with 65% probability. In the medium term of 1 to 3 months, the bearish scenario with 60% probability targets 0.5400 to 0.5500. Risk management principles are critical. Never risk more than 2% per trade. Use strict stop losses. Monitor the RBNZ on November 26th and the Fed on December 10th closely. Stay alert to global risk sentiment shifts and adjust strategies as conditions evolve. Trade cautiously in this volatile environment. Multiple bearish factors align, but remain prepared to adapt to changing market conditions.